Thank you all for that. I have a few simple-minded questions, and then I'm going to turn it over to the audience for people who have much more sophisticated questions than I have. So my first question is, I draw from what the three of you said that this is a little bit of a lot of attention to something that you don't think is a very big problem. It's a symptom of the Fed learning what ample reserves means. It's maybe a symptom of some unintended consequences of liquidity regulation that we could tweak a little bit. It's a symptom of changes in the way the market works. But bottom line, we shouldn't make radical changes because even though this looks very dramatic and makes a lot of us think, oh my God, this is 2007, 2008 all over again, it's not. Have I completely turned everything you said upside down, or do I have it right?
I'm okay. I'm so lucky I get to go first. Not quite. I do not disagree that if some of the things that both Dan and Jerome pointed out, and certainly stories that one hears, happen in a period of true financial stress, liquidity hoarding, and I'll use that word, by the very largest financial institutions when they themselves have ample liquidity would be a mess and a complete disaster. My argument about allowing for a certain amount of volatility is partly to learn exactly amongst the regulations, not just of banks, but I would say also some of the other regulatory changes, about what is it that is creating the binding constraint and could particularly, to our best estimate, cause a problem in a period of true financial stress. And so that's part of the reason I think this is worth looking at carefully and taking some time to learn a little from at least a moderate amount of volatility, if that's possible. Also, the regulations are not going to change fast, and so better that you start now. If you think you might, if you think there are pieces that you want to tinker with. That is a slow boat, as we all know.
I'll just add to that. The focus ultimately is the concern, not necessarily with primary liquidity within the market, but thinking about those second-order impacts to the market, meaning those that are impacted by the higher rates that we saw back in September. And more importantly, how the regulations by those primarily non-primary dealer participants could be impacted and how it's perceived. And that's the market risk that we have currently. Maybe some regulatory changes can alter that in the future. But the systemic, if that's viewed as a systemic impact and how to what degree, that's something that as practitioners we have to gauge and manage against and think about how it could impact the broader capital markets.
And so the point is that if this is a symptom of something much bigger and people perceive that it's a symptom of something much bigger, it could have, the ripple effects could be big. Is that your point?
Well, it may not be. I mean, quite honestly, it might be decided that the ripple effect might be somewhat subdued. Let's put this again in context. Context is important. The markets that were impacted, while severe on the overnight repo basis, was the repo market.
Right.
It wasn't the FX markets. It wasn't the basis markets. There's a lot of other markets that remain relatively inoculated from any type of further volatility, if you want to call it that. So it might be decided that whoever needs that marginal liquidity, it's just a function of that they were on the wrong side of managing the liquidity during those points of stress. I think the broader point is the fact that, keeping again in context, that the GSIBs were basically not short of liquidity back in September. That clearly was not the case. Regulations did exactly what they intended to do, and that's fine. It's the consequence of thinking about how they manage that liquidity against their own internal liquidity buffers, right. and ultimately how that comes into play with the CELA requirements, et cetera. And that's
we're going to keep this an acronym-free zone. You're violating the rules.
One, so there's no more.
You've used up your quota.
Yeah, that's it. So,
basically, what you're saying is the big banks had lots of cash, and the big conundrum is, given that they could have lent this cash for very high interest rates, they didn't.
Well, cash is not liquidity always to everybody.
Right.
And I think that that's what, when thinking about as a practitioner, you have to realize that
Right.
that's the friction within the market that exists today.
Dan, you can answer that question. Did you want to add something?
Yeah. Sorry, just one small thing. The second order effects that Jerome talks about really matter. Most of the U.S. financial system is not banks. Most of it is non-banks. And if the dependency, at least at the moment, is on that group and the liquidity stays there, that's not going to necessarily be helpful from a credit formation.
So why, I mean, Jay Powell and John Williams noted this in their letter to Congressman McHenry. Firms not subject to bank regulations, such as money market funds, GSEs, pension funds, also seem reluctant to step in and take advantage of very high repo rates in mid-September. So why is that?
Inexperience, nobody had seen it in 12 years, nobody has a limit, nobody has a trader. I'm sorry, I shouldn't say that.
I
It's
think
someone
that's
who
part of
actually
it,
runs
but
a
I
desk
also
here.
think
We'll be collecting liquidity at the back of the room when this is over.
Well, I think that there were participants who stepped in, but maybe not to the degree that
Right.
that was satisfactory. Let's clearly, if you get to a 10% repo rate when it should be, sub 2, that's some supply demand mismatch. But I do think that this all goes back to my point about thinking about the context of capital and more importantly, liquidity management and being defensive in that regard. And to those who are potentially susceptible to changes in funding costs, have to think about it as a more elaborate and approach to deal with this dynamicism that now exists in the marketplace. So is it a bad thing? No, it just simply, this episode highlights the awareness that the framework and paradigm simply needs to be adapted at that point in time.
So Dan, A, should we worry? And B, I was asked the following question at Thanksgiving by my niece's fiance who works on Wall Street. He said to me, everybody I work with thinks that when the Fed increases the balance sheet by $280 billion, that's QE, and they just don't want to admit it. What would you have said to him?
There we go. On the first point, on the first question you asked, yeah, to a considerable extent, I took the episode to reinforce my concern about the liquidity regulatory system in general. The two parts of it, the one I spoke a little bit about, which is the emphasis on pools that may never get effectively drained. And the second is that we're not, as Trish just said, we haven't brought into this system most of the U.S. financial system. And so in effect, I think, I mean, nobody would say this, but in effect, we're asking JP and Citi and maybe a few others to be the liquidity insurers for the entire financial system, which strikes me as not a particularly good position to be in. So that's why it just provoked these broader thoughts on liquidity regulation. As you can tell from what I said, I was trying to be sort of neutral on this, but I do think that allowing more, anticipating more, and almost demanding more volatility is actually a good thing. On the point here, the point, QE, quantitative easing is presumably designed to try to affect interest rates, or at the shape of the yield curve, or just where you are. That's not what the purpose of the bill purchases, and they are bill purchases by the Fed. They're
Right.
not 10 years that are being purchased. And so I'm sure that their aim is not to change the federal funds rate. They expect that the bills are going to roll off and they're not going to have that effect. I mean, we'll see. Sometimes people are surprised, but it certainly isn't QE in motivation, and I think the Fed has strong reason to believe it won't be QE in effect.
Right. Okay. So one final question, if I could just get a simple answer, a quick answer, and then I'm going to go to the audience. If it were up to you, would you create a standing repo facility at the Fed that would lend not only to primary dealers but a broader array of counterparties? Yes or no? All of you. It's like the siping of the presidential debates. Raise your hand,
So my answer to that is going to be, after 3 breakfasts with my colleagues from the business school and the econ department, I still don't know what I think of it.
Okay, that's a good answer.
If your concern is of the second order impact to the market, then obviously it has to be yes.
Yeah.
If not, then obviously no.
I'm going to be careful how I phrase this, since I sat on this stage and actually talked about preparedness for the next financial crisis about a year ago. Well, I'm looking at Bill English over there. On a chapter that we wrote, and one of our preparedness things was the Fed needs to figure out in advance, at least in extremis, how it would lend to the non-banking part of the financial institution. And one way to do that, without invoking 13.3 and a whole lot of other legal hoops, is to set up a facility that would basically take acceptable collateral with a relatively wide range of counterparties. None of those things would violate any of the new restrictions in Dodd-Frank. Whether it should be there all the time or not is the part that I'm still somewhat undecided about. But should it be there, and should it be known that the Fed could do this in extremis? I think that that level of moral hazard, at least I could deal with. Of course, I'm not a regulator either.
So just that paper and a number of others on the from a conference we did on the 10th anniversary of the crisis will be published by the Yale University Press in a book called First Responders in February of next year. And I promise you that Trish and Bill English will personally autograph your copies if you buy one. So let's, there are a lot of people here. I'm going to take 2 or 3 questions, then we'll go around. There's a woman there. Could you stand? So favor, wait for the mic. Tell us who you are and be respectful. There are a lot of people here, so let's keep it short.
Viva Hammer. Many people here have been talking about the idealness of volatility, and although raising the question, haven't addressed how you create a range for ideal volatility and what you want to accomplish from volatility. Is it just information, or is there something else that the market needs? Is it a kind of an inoculation against further volatility, or is it something more specific about the information that volatility gives to the market? So 2 parts. What is there a range? Should there be a range? How is it calculated? And second of all, what do you want to achieve by doing that?
Over here, there was someone. If you stand up, the mic will find an easier time finding you.
Yes, thank you. Professor Turley, you mentioned...
Can you tell us who you are?
George Selgin, Cato Institute, pardon. You mentioned Posar's writing about the role of the foreign repo pool. You didn't mention the role of the TGA, though Patricia talked about that a little bit. That's also another liability that used to be controlled very narrowly through cooperation between the Fed and the Treasury. My question for you and all the speakers who would like to answer is, why isn't the Fed talking about trying to rein in those liabilities by having foreign central banks and the Treasury take advantage of or come up with alternative places to park their dollars?
TGA is a Treasury account.
Sorry about that.
Over here in the front. If you stand up, the mic will have an easier time finding you.
Hi, Nancy Jacklin. I was wondering, you talked about the changes in this market since before the crisis, 2005. And I was wondering, in looking at the behaviors, have you taken a look at things like the fact there's only one tri-party repo facility now? It's Bank of New York, and JP Morgan is out of it. And the reasons they got out of it may also be affecting the reasons they're not there to continue to provide as much liquidity. And on the demand side, is there a real difference in who in the second order participants is really looking for all this short-term financing? In other words, is the demand in this market substantially changed, not just because of the amount of government borrowing that's out there that needs to be financed in the market, but is there a lot of longer-term demand, what should be demand for longer-term funds seeking shorter-term funds, and so distorting supply and demand dynamics in this market?
Okay, so you shouldn't all feel the need to answer every question, but we should get an answer to each question. So volatility. Why do we want volatility, and how much is too much?
I don't know how much is too much, but I think you mentioned several complementary reasons why you do want some volatility. I mean, to me, thinking of it as a policymaker, the most important thing is you don't want a situation in which markets get used to the notion that anytime there's a hiccup, somebody, usually a central bank, steps in. Because then, if somebody has a big hiccup, nobody will have developed, either prepared for or developed the capacity to respond adroitly to whatever is going on in markets. They won't have really priced risk in appropriately. And so to me, from a policy perspective, that is what's important. I think Jerome could probably speak better to the learning on the market side, but I think it's basically the flip side of what I was saying a minute ago.
Yeah, I would concur with some of that. There's from a practitioner point of view, you have to have these degrees of freedom, and not everybody has them the same as pre-crisis. And so the cost of that liquidity is inherently correlated to the volatility you see in the market to that regard. The fact that we've had zero volatility or near zero volatility because of monetary policy and other structural changes lends itself to, when any does occur, it becomes this headline grabbing experience when frankly it shouldn't. And it's something that the repo markets have, as we've seen from the charts that Trish highlighted, is something that we're just reverting back to the old normal, if you will. So with that regard, we just have to adapt and think about modest volatility as being part of the day-to-day structure, especially over reporting dates like quarter ends and year ends, especially if we don't get out of this habit of discrete reporting periods. So,
Trish, do you want to take the tri-party? Should we worry that there's only one tri-party?
There are reasons to be concerned that there's only one tri-party provider, but I don't think in the context of volatility, frankly. Honestly, I'm guessing, I have to go back and my rough memory is that the Bank of New York was probably at least 75% of the tri-party market in 2005 as well. So I don't think it's really correlated with at all with
Just to be clear,
volatility.
the tri-party market is where the lender and the borrower work through an intermediary, in
Correct.
this case, the Bank of New York.
Right now,
as
and
compared to other deals where it's just between the borrower and the lender, and there isn't.
Correct. And in 2005, there were two institutions who did that, Bank of New York Mellon and JP Morgan Chase. Now there's only Bank of New York Mellon. It was always frankly, always having a small number of infrastructure is a risk, but it's a different kind of a risk from this. I'll also make a comment about George's question about the Treasury account and the foreign repo pool. I'm probably showing an old-fashioned central banker here, but I have no idea whether the Fed is speaking to those counterparties about the facilities or not, but my personal opinion is that they should be. The Treasury account has always been a source of volatility, and it's one reason that it was very small historically. And in fact, the volatility was kept as low as it humanly could. Let me be clear that the foreign repo pool is not particularly a source of volatility on the Fed's liability size. It's just large. And on top of that, these are people who could be, or institutions, who very easily in private markets, if they did not repo with the Fed, could in fact be opportunistically take advantage, not exactly arbitrage because they're not intermediaries, but literally take advantage and help to close some of the gap in when you have things like spikes in repo. And so the fact that they're on this side as opposed to that side of the ledger.
You mean a foreign central bank doesn't go into the market and help smooth this volatility because they have this special deal with the bank?
Exactly. Thank you.
Sure. Here, you stand up, please. And then there's one in the back. In the back, if you stand up, the mic will, yeah, thank you.
Sean Egan, Egan Jones Ratings Company. We are named the #1 firm for warning about the credit crisis of 2008 by Fortune magazine. My question is, what if you're wrong? What if this is an early indication of bigger problems? And that is, and you don't know, by the way, ahead of time, that is that you have a structural change in the indebtedness of a lot of countries that are right now using their central banks to support the funding needs of various countries. And what if this is an early indication, not of some mismatching or anything of that, but a more structural problem? What early indications might you have, and how do you respond?
Thank you.
Hi, my name is Sebastian Infante. I have a question that regarding the drain of liquidity. The triggers were the settlement of Treasury and of tax payments, and those presumably settled on the 16th. and yet we saw the biggest increase in volatility on the 17th. So my question is was that surprising to people on the panel, and may that be an important piece of evidence for us to think about how banks actually manage liquidity in terms of what they've experienced and what they think may be happening going forward? Thank you.
There's a woman here. If you stand up, please.
Thank you. My name is Una MacDonald. I have rather a different question. Does the volatility experienced in September and the New York Fed's continuing support of the repo rate, does that not affect the usefulness of SOFR as the replacement benchmark for LIBOR, particularly in view of the fact that SOFR is essentially a backward-looking rate, whereas LIBOR, which I believe should be retained, is a forward-looking rate? Thank you.
Thank you. All right, let's start with the narrow ones first. So is there something about the 16th and 17th, Jerome, that tells us something?
No, I mean, quite honestly, we started to see it very early in the morning on the 16th, and so while it wasn't headline grabbing for probably another 36 hours, quite honestly, it was something that we saw starting probably about 5:30, 6 o'clock in the morning. Well, that's Pacific time, so sorry about that.
Jerome told me he gets up at 3 a.m. every morning. That's the advantage of living in California.
It's all dark. It doesn't matter where you are. So, but there was...
PIMCO Trader says we're all in the dark.
Did not say that.
Sorry.
Right. my media folks are going crazy right now. Thanks. Anyway, in all sincerity, if anything, we're not in the dark about the liquidity markets. We always continue to look at them on a real-time basis for that barometric pressure indicator. So what I would say is the transmission mechanism worked effectively. What we started to see is the second-tier demands start to come in what we call reg repo. The repo not for cash settlement, meaning same day on that Monday, but the one for T+1, meaning the Tuesday and beyond, which is why it was very useful for the market to only be placated once we had a response that was term in nature, not simply the overnight market operations that were one day overnight, but we had something going for 2 weeks at a time. So getting ahead of the curve is essential. So we did see it pretty early on. Again, we often have settlement. We often have late day blips in terms of funding. That's something that we've always dealt with in market operations and funding operations. But it also leads to we typically will see these blips materialize now in this current paradigm, T+1, meaning trading for tomorrow's settlement, because that's a way that the banks can avoid their daylight overdraft charges.
So Dan, what if this is an indication of something bigger and we just don't understand what it is?
Well, I mean, two things about that. One, you always have to kind of do your best, make your best judgment, because at some level you can be wrong about everything. And so in terms of policy response, that's the way people have to think, number one. Number two, I guess three things. Number two, when something happens that in and of itself is not hugely troubling, but you think it may reveal some problems somewhere else, you should probably spend some time. That's why it's provoked me to talk more about liquidity regulation writ large in the system. And three, and this is really quite important, so when the Fed created the office, now Division of Financial Stability, part of the idea was what Nellie and the people who started that office did was to basically take everything that was happening that the mainstream Fed staff said, oh, yeah, it's okay. Don't worry about that. This is okay. And ask the question, well, what if it's not okay? What else might be going on to have produced this? And it wasn't that they believed it all the time, but they were an institutionalized intellectual devil's advocate that we thought of, and I know the guys at the Bank of England think the same way, as an important institutional component of any financial regulatory system. But you got to invite it. You have to actually foster it, and you can't get angry with people when they tell you there may be a bigger problem here than you think. And I hope that's still going on at the Treasury, at the FSOC, and the Fed.
I actually interpreted your question slightly differently as much more of a fiscal risk. Maybe that's because I just misheard you. So correct me, a combination. And there's absolutely no question that the degree of fiscal risk in the United States is higher. It's very high in Japan. Of course, it's been very high in Japan for a long time. Not as high in Europe, although in certain countries it is, obviously. The U.S., of course, has unbelievably exorbitant privilege of being the benchmark currency for the rest of the world, and so it's incredibly difficult to judge. It has happened historically that demand for U.S. Treasuries has gone up. But it's very difficult to know exactly when that point is because it happens very rarely. So is that a risk? I think it is. It's a financial stability risk. It gets highlighted. I don't know that there are many signals other than the repo market having a little trouble swallowing things, but that's happened a lot without there being an actual fiscal crisis. So I don't know, but it's certainly worth keeping an eye on, particularly given that the size of the deficits are not going to be going down anytime soon, as far as I can tell.
Trish, we're switching from the London interbank offered rate to the secured overnight financing rate, which I will not define. Does this tell us anything about that?
I'm actually less concerned about that. The part of the LIBOR transition that I'm more concerned about is the fact that it was the last thing you said, which is that this is not a forward rate. There's not a forward market yet. It's just an overnight rate. There will be, or there needs to be for it to be viable. Yes, exactly. No, and I know the deadlines, which is interesting. I'm not close enough to the debate to know, or to the inner workings of what's going on to know. Maybe other people know more about this. But my much bigger concern is, when is that forward market going to get going and be big enough that we can actually use, that it's actually usable. So.
Do you have a final word on that? Okay.
I wanted to address a question that was posed that wasn't addressed.
Okay. Yes,
So
you're right.
I'm going to not get this 100% correct, but the question basically was: is there something in the market structure today that lends for potential disruption between the demand for term funding, term liabilities, and asset mix? And I think it's important to say that this has always been a function of the market. And typically, back in the day, you had commercial banks who had a much more fungible balance sheet and appetite that provided that term funding at a cost, because that's what they do. But now in this environment, there's been things to supplant that and to obviously change that risk tolerance. One of those things, quite honestly, is the evolution of the structured, the evolution of the sponsored repo market. And what sponsored repo basically is effectively taking collateralized lending and moving it to centrally cleared domains. The point I would make there is that a lot of that is done via overnight demands, overnight repos. And so while there is incremental supply of balance sheet, it's coming in the form of very short-dated appetite. And I would just say that one of the things as a risk manager we always think about is that cost of liquidity, and more importantly, how to more appropriately structure that. But just because you have ample liquidity to meet on a daily basis supply and demand doesn't necessarily mean that the term horizon for funding is actually been met. So it's a great evolutionary development in the funding in the repo markets, but at the same time we should also be cognizant that there's the potential for that mismatch to open up one day, and we need to be prudent about how we approach that as we are.
Okay, I want to thank the panel. We're only just beginning. We're going to take a 10-minute break, so we'll resume. There's coffee outside, but we're going to try and get going shortly after 3 o'clock, so drink quickly or whatever else you have to do.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.